Loyalty is a virtue. In fact, for most of human history, loyalty was the primary currency of survival. In the Stone Age, if I watched your back while you slept, you watched mine. If I shared my kiln with the tribe during the summer, the tribe shared their fire with me during the freezing winter. We are biologically wired to value loyalty. We are wired to stick with our tribe, to trust long-term relationships, and to fear the unknown. Breaking a bond wasn't just rude, it was a death sentence. But in the modern financial world, this ancient biological imperative has been weaponized against you. There is a tax that does not appear on any government form. It is not levied by the IRS. It is not deducted from your paycheck by the state. It is a tax you pay voluntarily every single day, often without even knowing it. It is called the loyalty tax. It is the price you pay for staying with the same bank, the same insurance company, and the same service providers for years, simply because it feels safe. You think you are being a good customer. You think that because you have been with Big Bank X for 20 years, they respect you. You think that when you need a loan, they will look at your history, see your dedication, and treat you like family. I am here to tell you the ugly truth. To a bank, you are not family. You are not a partner. You are a data point, and the longer you stay, the more they exploit you. They have a term for loyal customers in the industry. They don't call them partners. They don't call them valued clients. They call them sticky. And in the corporate world, if you are sticky, you are about to get squeezed. My name is Brock, and today, we are going to calculate exactly how much your loyalty is costing you. We are going to expose the algorithms that track your laziness. We are going to look at the psychology of learned helplessness. And I am going to teach you how to stop being a victim and start being a mercenary. Let's start with the math. Because while loyalty feels warm and fuzzy, the numbers are cold, hard, and absolutely brutal. Let's look at the most common crime scene in America, the standard savings account. Most people open a bank account when they are teenagers. Maybe your parents took you to the local branch on Main Street. You shook hands with a nice lady in a blazer. You got a debit card, a checking account, and a savings account. And now, 20 years later, you are still there. You have your direct deposit set up. Your Netflix subscription is linked. It feels comfortable. It feels stable. But let's look at the cost of that comfort. Currently, the national average interest rate for a standard savings account at a Big Four bank is around 0.01%. APY. Let's translate that into caveman terms so we can truly understand the insult. If you give the bank $10,000 of your hard-earned labor money you bled for, money you traded your life for, and you leave it there for a full year, they will pay you roughly $1. $1. That is the price they put on your loyalty. That is the value they assign to your capital. Now, let's look at the mercenary. The mercenary doesn't care about the bank's logo. The mercenary doesn't care about the nice lady in the blazer. The mercenary cares about yield. The mercenary moves their money to a high-yield savings account, HYSA, or a money market fund. Right now, those accounts are paying around 4.5% to 5.0% APY. If the mercenary takes that same $10,000 and puts it in an HYSA at the end of the year, they don't have $1, they have $500. The difference is not double. It is not triple. It is 500 times the return. Now, I know what you are thinking. Brock, it's just $500. It's not worth the hassle of switching banks. I'm busy. I have a job. I have kids. This is exactly what the bank wants you to think. They want you to think in short time frames. They want you to think in terms of gas money. But wealth is not built in days. It is built in decades. Let's run the numbers over a lifetime to see the true cost of your apathy. Let's take two characters, Loyal Larry and Mercenary Mark. Both men have $50,000 in cash savings, an emergency fund. Both men add $500 a month to their savings from their paycheck. They do this for 30 years. Loyal Larry stays with his big bank earning 0.01%. Over 30 years, his money grows, but barely. He is essentially stuffing cash under a digital mattress. At the end of 30 years, Larry has roughly $230,000. That sounds okay, right? He saved his money. But now, look at Mercenary Mark. Mark moves his money to get 5%. He chases the rate. At the end of 30 years, Mark doesn't have $230,000. Mark has $690,000. Do you see the difference? It is nearly $500,000. That is the price of the loyalty tax. Larry paid $460,000. For the convenience of not changing his direct deposit settings, he paid $500,000 for the comfort of seeing the same bank logo on his app. And here is the punchline. How does the bank make money? They take Larry's $50,000 and they lend it to Mark for a mortgage at 7%. They pay Larry 0.01%. They charge Mark 7%. They pocket the difference. This is called the net interest margin. Larry is not the customer. Larry is the raw material. Larry is the livestock. But the loyalty tax isn't just about savings. It's about debt. And specifically, the credit card upgrade trap. If you have been with a credit card company for 5 or 10 years, you might notice something. They rarely offer you 0% APR. They rarely offer you massive bonus points. Instead, they offer those things to the new guy. Walk into any airport, you will see booths offering 100,000 bonus miles just for signing up. You will see offers for 0% APR for 18 months on balance transfers. Who pays for those perks? You do. The loyal customers, the ones paying 24% interest, the ones paying the annual fees year after year subsidizing the acquisition cost of new customers. This is a phenomenon known as churning economics. Banks know that acquiring a new customer is expensive, $200, $500 per head, so they throw money at strangers to get them in the door. But once you are in the door, once you are sticky, the freebies stop. The interest rates creep up, the annual fees increase. If you are holding a credit card that you opened 10 years ago, check the benefits. Compare them to what that same bank is offering a new applicant today. I guarantee you, the stranger is getting a better deal than you are. You are paying for your own replacement. So, if the math is so obvious, why do we stay? Why do 70% of Americans still keep their savings in accounts that pay almost zero interest? It is not because we are stupid. It is because the banks have weaponized psychology against us. They rely on 3 powerful psychological levers: friction, fear, and status quo bias. Let's talk about friction. Banks intentionally make leaving difficult. They create sticky products. Notice how they want you to sign up for bill pay. Notice how they push you to link your external accounts. Notice how they offer you a slightly lower mortgage rate if you open a checking account with them. They are not doing this to help you. They are doing this to weave a web. They know that if you have 10 automatic bill payments set up, the pain of switching banks is high. You have to log into Netflix, Hulu, the electric company, the gym, and change your card details for every single one. They are betting on your laziness. They are banking on the fact that you will pay thousands of dollars in lost interest just to avoid 2 hours of paperwork. Next is status quo bias. Humans act in accordance with Newton's first law of motion. An object at rest stays at rest. We view doing nothing as a safe choice and making a change as a risky choice. Even if the current situation is costing us money, we prefer the devil we know to the devil we don't. And finally, the relationship myth. This is the saddest one. Many people, especially older generations, truly believe they have a relationship with their bank. They think their tenure matters. Let me break this down for you. The person at the local branch might be nice. They might give your dog a treat, but they have zero power. The algorithm runs the show. When you apply for a loan, the computer does not check a box that says, "has been a nice customer for 20 years. It checks your credit score, your debt-to-income ratio, and your collateral. That is it. A brand new customer who walks in off the street with a better credit score will get a better rate than you, even if you have banked there since 1995. If you think banks are bad, wait until we talk about insurance. This is where the loyalty tax turns into predatory science. Have you ever noticed that your car insurance premium goes up every year, even if you have a perfect driving record? You haven't had an accident, you haven't gotten a ticket, you drive a safe car. And yet, the bill creeps up. $50 more, $100 more. Why? It is called price optimization. Insurance companies use massive data sets to predict not just your risk, but your elasticity. Elasticity is a fancy economic term for how much can we rip this guy off before he actually quits. They categorize customers. Customer A is a shopper. This person checks rates every 6 months. They switch carriers for a $10 savings. The algorithm flags them as high flight risk. The insurance company keeps their rates low to keep them. Customer B is a sleeper. This person has been with the same company for 5 years. They have autopay set up, they never log into the website, they never call customer service. The algorithm flags customer B as low elasticity. It says, we can raise this guy's rate by 12% this year. The data shows he is 98% likely to just pay it and not complain. This is not a conspiracy theory. This is standard industry practice. They are charging you more specifically because you are loyal. They are penalizing your stability. By staying with the same insurer for more than 2 years, you are almost certainly overpaying. You are paying a tax for your own apathy. Now, let's get philosophical. Why does this hurt so much? Why does it feel like a betrayal? It is because we are projecting human values onto non-human entities. We are anthropomorphizing the corporation. In a tribe, loyalty is reciprocal. If I am loyal to you, you are loyal to me. It is a two-way street. But a corporation is not a person. A corporation is a machine designed to maximize shareholder value. The relationship between you and a bank is asymmetric. You give them loyalty, a human emotion. They give you extraction, a mechanical function. You cannot have a relationship with an algorithm. You cannot be friends with a spreadsheet. When you understand this, the emotional weight lifts. You stop feeling guilty about switching. You stop feeling like you are cheating on your insurance agent. You realize that you are a CEO of your own life. Your money is your employee. If an employee your savings account showed up to work and produced 0.01% output, while another employee, an HYSA, could produce 5.0% output for the same job, what would you do? You would fire the first employee immediately. You wouldn't feel bad. You wouldn't worry about their feelings. You would make the business decision. You must treat your financial service providers with the same ruthlessness that they treat you. So, how do we escape the loyalty tax? How do we stop bleeding millions of dollars over our lifetime? You have to adopt the mercenary mindset. Step 1. The audit. Look at your accounts right now. What is the interest rate on your savings? If it starts with a 0, you are being robbed. When was the last time you shopped for car insurance? If it was more than 2 years ago, you are being robbed. Step 2. The switch. Open a high-yield savings account. It takes 10 minutes. Change your direct deposit. It takes 5 minutes. People talk about passive income. Switching your savings from 0.01% to 5.0% is the ultimate passive income. It is free money that requires 0 additional labor from you. Step 3. The rotation. Make it a habit. Every year, spend 1 afternoon shopping your rates. Call your internet provider. Call your insurance agent. Tell them, I have been a loyal customer, and I see new customers getting a better price. Match it, or I leave. You will be amazed at how quickly they find a manager's special discount when they realize you are awake. Step 4. Kill the brand loyalty. Stop walking around with a debit card that acts as a billboard for a bank that hates you. Stop taking pride in your platinum status if that status costs you money. Be loyal to your family. Be loyal to your friends. Be loyal to your principles. Do not be loyal to a bank. The financial industry relies on your sleep. They rely on the fact that you are too busy, too tired, and too polite to fight for what is yours. They are counting on you to pay the loyalty tax until the day you die. But now you are awake. Now you know the math. Now you see the algorithm. Your money belongs to you. It should work for you. It should grow for you. Stop giving it away to strangers who smile while they pick your pocket. Fire your bank. Hire a better one. And never pay the loyalty tax again. I'm Brock. Stay sharp. Stay mercenary. I'll see you in the next one.